Glyn, we've had a strong few months in the markets now. How did October look relative to that?
Well, October was a month of consolidation, I would say. The broad indices were down slightly, so MSCI World Index of Developed Markets down 0.7%, emerging markets down 0.6%. So it was certainly a flatter month, but intriguingly, underlying all of that, the sentiment still remained pretty good, and quite a few markets were more in a risk-on mood than a risk-off. So in fact, in equity markets, it was only really the US that fell. The US was down by nearly 2%. The other markets actually rose quite a bit. Europe up over 1%, Asia up 1.8%. So it was still actually broadly a risk-on as opposed to a risk-off month, but some consolidation.
At the same time, government bonds generally a bit weaker?
A little bit weaker. The safe haven government bonds a little bit weaker, so the government bond index down slightly. But again, I think an indication of the risk-on mood was the fact that the peripheral European government bond markets produced good returns again. Spain produced a return of 2.5%, so yields coming down a little bit again. Italy, a couple of percent. And credit did well, had a very good month, positive returns, about 1%. High yield did well, emerging market bonds did well. So all the indications, again, as with the equity markets, pointed to still a risk-on mood as opposed to a risk-off mood.
And to cap it all off, pretty major exogenous shock towards the end of the month as well.
Yes, that was obviously a big windstorm like that. Hurricane Sandy comes completely out of the blue. Obviously, we're in the windstorm season, but to hit the eastern seaboard of the United States is a big issue because, of course, it's a very densely populated part of the United States. The first time for decades that the New York Stock Exchange was closed for 2 days. The insurance estimators are still working out the scale of the losses, and the numbers are going up all the time, but at the moment they're talking about insured losses of as much as $20 billion, and total losses could be double that. There'll be obviously a big chunk of uninsured losses. The difficulty that arises, that gives rise to, apart from the problems, the immediate short-term problems for the people affected, is the impact on GDP numbers in the US, because of course the initial impact will be negative, activity stops for a while, but the spending on the reconstruction is going to be very significant. Some people are putting it as high as 0.5% of GDP, which will come through over the course of the next quarter or two. So the next couple of quarters of US GDP numbers will clearly be distorted by this very major event, the third largest insured loss on record, incidentally.
While we're on the subject of GDP, economics globally are producing mixed results at the moment. Any bright spots?
Well, the central banks clearly remain in easing mode, and they're going to remain that way for a very long time to come. I mean, I think we're talking about years ahead when policy is going to be loose, because we're looking at sluggish growth for quite some time to come. Europe remains mired in recession, so there's no doubt the ECB is going to remain very loose. I don't think it'll cut interest rates further. It's meeting again this week. But within Europe, the core countries, Germany and France in particular, look as if they're slowing and could be going into recession. Peripheral countries stabilising a little bit, but overall the ECB is going to remain very loose. The big news in the month was, however, the Bank of Japan, which engaged in a further round of quantitative easing, another 11 trillion yen, $140 billion, takes their total QE package to $1.2 trillion, I mean a huge number, which they're spending on Japanese government bonds, corporate bonds, selected equities. And the important part of the statement they made in the past month is that they're going to continue with that easing program until inflation reaches their target of 1%. And remember, Japan's been in a deflationary environment for a decade or more, so I think a very significant number. And I think also important that against that backdrop, the yen finally declined somewhat, down by almost 3% in the month. And I think that is a good indication of the extent of monetary easing going on in Japan. And incidentally, a positive for the equity market. A falling yen will definitely help that big export sector in the Japanese equity market.
Japanese equity market, clearly an interesting area, but elsewhere in the equity market, REITs remain strong?
Yeah, REITs have have really surprised on the upside this year, quite frankly, because we've seen returns of 20 to 25% from REITs, generally speaking, around the world, despite the fact that the property market, the real property market, has remained pretty sluggish. So that has certainly been a surprise. I think it's indicative of investors' search for income. But one of the strongest property markets, direct property markets, has been Hong Kong this year, up 20-odd%. A lot of speculative activity there, a lot of mainland Chinese buying, and pricing a lot of locals out of the market. Intriguingly, in the month, the Chinese authorities imposed additional property taxes, a 15% property tax on non-permanent residents of Hong Kong. So the property sector in Hong Kong was actually quite weak in the month, although the market itself remained pretty strong. It's been a good market this year. Property securities have certainly surprised on the upside and look to be fairly fully valued to us.
Okay, thanks, Glyn. Taking a step back then, looking at the broader risks in the system, one key one, the US election, which is happening today.
Yes, well, of course, November is going to be a big month for elections because we've got the US presidential election literally starting in a few hours' time. It looks, I think everybody knows the candidates Romney and Obama are neck and neck in the polls, but importantly, Obama is ahead in the key battlegrounds, and most importantly, he remains a couple of points ahead in Ohio. Whoever has won Ohio since 1964 has become president of the United States. So it looks to us as if Obama is going to win this election. We'll know that literally within about 12 hours. Ohio is due to announce fairly early on. I don't think it will make much difference to the stock market if that is the case. I think it's discounted. And interestingly, I noted yesterday that one of the bookmakers here in the UK has already paid out on Obama. So I think the market is discounting an Obama win, and I don't think there'll be any sort of change in market sentiment or direction. It will lead to very difficult and serious negotiations on the fiscal cliff, but that's going to happen whoever wins the election. And I think that's an area of significant uncertainty for the market over the next few weeks, because that's got to be sorted before the beginning of January next year. The other so-called election is in China. We have the 18th National Party Congress this month, where they will be electing a new leader. Of course, they've already determined who that will be, and people don't get a say in that, but we don't know yet, although there are pretty clear indications. I think there's some real challenges in China. We know the economy has been slowing. There's some suggestions, some figures coming out recently have showed some stabilization, but still a much slower rate of growth and a structural slowdown in the Chinese growth rate. So they've got to address that challenge, and over the next few years they're going to have to address the challenge of a falling working age population. That's going to happen in China. So there's some significant demographic issues to come along in China. So yeah, two really very big elections. Probably the biggest challenge comes in China, would be my guess, over the next several years from whoever leads that country. And so November, I think, is going to be dominated by those events. But overall, markets remain in, I'd say, reasonably constructive mood, consolidating after the sharp rises that we have seen since late June. And we do now need to see the economic fundamentals catching up a little bit with what has happened in markets, strong rises on the back of monetary easing. But generally, I think markets are poised for further upward moves over the course of the next 12 months, and we're looking for opportunities to add to our positions.
Brilliant, thanks, Glenn.